All right, welcome. Today is a sixth video of the playbook. We are going over time. For those that have made it so far, congratulations. And thank you so much for tuning in, for taking the time to really study this, to really study the playbook, and for elevating your trading game, to learning, to being a student. And just know, guys, that it's very, very important to always remain a student, to always continue to study, and to continue to improve your skill set. Now, today we're going over time. Time is actually one of the most important steps before entering a trade, before executing a trade. And I want to go over Forex Factory. Forex Factory is a website where I use to track news, to look at different events, and what's going on in the world, what's going on in the economy, giving me the data, the numbers. Now, timing is very important, and we have different sessions happening in the markets. We have the Sydney session, we have the Tokyo, we have the London, and we have New York. These are the different trading sessions that happens throughout the day, throughout the week. And why is time so important? In trading, time is just as important as price. Markets move in cycles, and timing helps traders understand when a move is likely to happen, not just where. We are so focused on where it's going to happen, where is the trade, market structure, technical analysis, but timing is just as important, especially when it comes down to fundamental analysis. You have two different types of traders. You have the fundamental trader and you have the technical trader. Me, I'm more of a fundamental side of the things. I do technicals, but I'm leaning more towards fundamentals and looking at news, time, and doing my research. Doing more of the research to study before I dive into any technicals. I like to make sure that the data that I'm gathering is it's it's accurate and it's precise and it's another form of confluence on top of my tentacles. Now, remember, markets move in cycles, and timing helps traders understand when a move is likely to happen, not just where. These market sessions, these different types of market sessions, bring different levels of volatility and liquidity in the markets. Now, we can see here last week we had a pre-booked week. We had a booked week full of events and we had the Jackson Hole Symposium. We had PMI events. Now, this past Friday, we had Federal Jerome Powell speaking at 7 a.m. Arizona time, which is 10 a.m. Eastern, 9 a.m. Central. We had Jerome Powell speaking, and we'll go over the charts in a bit here, how it impacts directly in the charts. Now, the timing of these entries, entering too early or too late can turn a good idea into a losing trade. So when you enter a trade too early or too late, it can turn a good idea into a losing trade. So timing in the markets, you got to understand when to act and when to wait. It helps you catch high probability moves, manage risk better, and grow consistently. And for those that are taking notes, time in the markets, put this in bold letters, write it down, put it in bold letters. Time in the markets equals understanding when to act and when to wait. Put that in bold letters, all caps. Make sure you guys remember that. So when you guys are looking for potential moves in the market, you want to notice the different times, okay? Why did this bullish move happen at 7 a.m.? This is Arizona time. So wherever you're watching, wherever part of the country, the world, it's based on your respective local time. Now I'm looking at Arizona time. So this move, this bullish move happened at 7 a.m. on Friday, this past Friday. Why did this happen? Why did this bullish move happen? Why did this occur? As we recall, at 7 a.m., Federal Jerome Powell was speaking. So the Jackson Hole Symposium was happening during this time. That is why the market reacted when that news happened because he was giving uh, indications of a potential rate cut happening in September. When there is a potential rate cut, that is negative news on a dollar, resulting a bearish move on the dollar and a bullish move on all asset pairs. That is why you see gold. We're looking at gold here. We're looking at gold pushing price up to the upside because it resulted a negative news on the dollar because whenever there's a rate cut, whenever there's a high unemployment, whenever we see in these news happening, these news events happening in the markets, resulting in a negative impact on the dollar, it's a bullish impact, a positive impact on all asset pairs. So it's an inverse relationship amongst each other between the asset pairs and the dollar index. And whatever dollar index, whatever the USD, for example, here, gold against the USD. So it's potential, it's a positive move. It's a positive move on gold, but it's a negative move on the dollar index. And we can see here, when we look at the dollar index, it resulted a bearish move to the downside. Here, you see, you see the inverse relationship happening here. So you can also use the US dollar index as a as another indicator to see where the rest of the asset pairs are going, whether up or down. If there's bad news happening, such as a rate cut, right? The the Fed does not want to cut rates right now, right? They're waiting for adjustments in policy. They're following their dual mandate. So they're waiting to see for any policy adjustments, especially with the tariffs, before any rate cuts. But Trump and all these officials, they're pressuring Federal Jerome Powell to cut rates because it's been over a year now since our last rate cut. We've been at the same percentage, the same range between 4.25, 4.5 in that same range for the past year. Now, the reason why Federal Jerome Powell does not want to cut rate right now is because he's worried about inflation. He's worried about, uh, he's worried about inflation. He doesn't want inflation to continue to rise. So that's why he's waiting. But that's another conversation for another day. And the more you study these news, the more you study the time, you understand these things better. Now, for the sake of this call, we're looking at time. So here we know that at 7 a.m. Arizona time, this big engulfing bearish candle happened on the dollar index, and this bullish engulfing candle happened on gold is because there was news at that same time. Jerome Powell was speaking, so it resulted a bullish move to the upside. And this happened during New York session. So during New York session, it's high volatility. And when it overlaps with London, it's the best time of the day to trade. When you have, uh, the New York session, I trade New York session. So personally, uh, it's the best time to trade in a day. During New York session, there's news events, there's CPI, non-farm payroll, there's the federal rate cut happening. There's all these news events, unemployment claims, jobless claims. There's job openings. There's these different types of news events. Uh, as you can see here in Forest Factory, most of the news events happen during New York session. Therefore, there's high volatility happening in the markets, which is good for traders because we get to catch these high volume trades. And the best pairs to trade are USD majors, USD pairs like gold against the USD, Euro USD, uh, and these pairs, right? Silver against the US dollar, and the S&P 500, the stocks, right? It, it's the best time to trade these pairs during New York session. Me, I'm a huge fan of gold. I like to trade gold. It respects price, it respects the key levels. And me personally, that's why I'm looking at gold right now because it's good when it comes down to this concept, especially when it comes down to the playbook. It works beautifully. This strategy works beautifully with gold. When I tell you it works beautifully, it works really, it's just nice. It's very nice. It's very nice. And I enjoy trading gold using this strategy, and especially because it respects price and it's volatile as well. So here we see a bullish move at 7 a.m. And then we see when we go down to the 30-minute, New York open at 6:30 Arizona time. So we see here at 6:30, it resulted another bullish move to the upside. And then when Jerome Powell started to speak at 7 a.m., it resulted in this bullish candle. So you could have caught a buy here, right? Um, so, and we can see another example here. 6:30 here, 6:30 was New York open. The bell rang. This was Thursday, 6:30. And then we have 5:30. This was news right here at 5:30. Uh, this actually 5:30 is right here. Boom, 5:30, another bullish candle here at 5:30 resulted a another news event. Unemployment claims happens every Thursday at 5:30 Arizona time, which is it's 8:30 Eastern, 7:30 Central. We can see here unemployment claims here at 5:30. We go back to the charts here, 5:30, resulting in this bullish candle to the upside. And when you see unemployment claims, it resulted a 235, 235,000 people filed for unemployment claims, resulting a bullish uh, candle on the dollar index and resulting a bullish candle as well on gold. But look what happened after. It resulted a push down. It resulted in a push down. Actually, I'm sorry about that. Let me go back. 235, it was higher than the previous number. So 235, the number of unemployed people increased from 224 to 235, resulting a bearish candlestick on the US dollar, on the US index, and a bullish momentum, uh, a bullish candle for gold, right? So we see here, we can look at the dollar here. Let's go back to Thursday, 5:30. So we see that this happened Friday. This news event was Friday when at 7 a.m. when Jerome Powell spoke. And then we can look at Thursday. The big news before that, before Friday, was Thursday at 5:30. Go back here. 5:30. Here. Boom. You see here was unemployment claims, resulting a bearish candle on the US dollar index because the number of unemployed people increased, therefore resulting a bearish candle is negative news on the dollar. So it resulted this bearish candle pushing price down, wiping out all this liquidity here. wiping out all these buyers, all this liquidity because of this wick before the continuation to the upside. So you can see that whenever there's news event, there's always a liquidity sweep. There's always people getting liquidated. So same thing here with the US with the gold. 530 resulted a bullish candle. You see that? At 530 resulted a bullish candle on gold, but a bearish candle on the US dollar index. So that's how you can that's why it's so important to look at time. And you wanna avoid trading during time, during avoid trading during news because you can get liquidated. And you wanna wait after the news event for a to spot a trade. So here you can see at 6:30 on Thursday resulted this doji candle here, right? And when you see here, this level here, 33.45 here. Actually, yeah, that's good. 33.45 there. This is a key level on gold. Price was rejecting around this price was rejecting around this level. Why? Because look, we have this is a resistance level. This is a resistance level. And there were also some imbalances here, right? Imbalances that were filled. And we can see here, you see here, let me go back. So this was a price level here. A supply zone. Oops. There's a supply zone here. You can see here we have this order block. We have this order block right here, creating this imbalance. You can draw the zone. So this is our supply zone. We have our supply and resistance level here. So price came up to retest this area, broke below structure here, came back up, and it resulted this doji, this what's it called? A gravestone doji. Yeah, this is a gravestone doji resulting a push to the upside. So this is a candlestick confirmation pattern here, resulting a bearish move to the downside. Here you could have entered. And this happened at New York Open at 6:30 on Thursday. It happened right at New York Open. As soon as New York Open, this resulted. This bearish move happened. Boom, to the downside. You could have executed at the 15-minute or 5-minute here, clearly at the 15-minute time frame and gave you this gravestone doji. Could have entered here for a sell to the downside. Could have caught this sell to the downside. Practice your risk management. You can either do 1, 2, 3, or 125, risk to reward, boom, to the downside. I like to enter, at the, half, 50% of the zone. Put my stop loss above the zone here, a couple pips above the zone here. Could enter for the sell there. For a 125 risk reward. You could have held it. You see how far it went down? You could have held it for, man, it went from 33.46, 33.45 area down to 33.23. That's what, I mean, from here to here, that's about 250 pips. No, I'm sorry, that's 2,500 pips. So that's 2,500 pips to the downside. 2,500 pips to the downside. You could have caught this, right? So actually, I might be wrong. That's not 2,500. I'm looking at the 15-minute. That's 250 pips. Yeah, 250 pips. Because every $10 to 4. Yep. Yep, 250 pips. So, anyways, that's how you can tell, like, looking at the time here, you gathered uh from 345 to 338 here to here. That's about 80 pips right there. 80 pips for 1 to 5 risk to reward. That's about 80 pips. From here to down here, that's 250 pips. So I had to correct myself. I was over exaggerating earlier. That's not 2,500 pips. That's 250 pips from this entry down to this low. That's 250 pips. So here in this 1 to 5, that's about 80 pips. And at the same time, you don't want to be greedy, right? You want to practice proper risk management and and catch your trade, follow your trading plan and be out. Yes, there's potential moves here. You could have caught the rest of this sell. You could have entered for another sell entry here, right? After this break of structure, you could have entered here for another sell to the downside. So you can always divide this up, right? To other different types of orders. So here in this, for the sake of this example here this is a prime example of why you know timing is so important because you'll be able to catch the moves more effectively and more efficiently. Now, the Asian session are slow to build up. It's a slow build up. The London session, you get big moves and transform. New York session, it's a continuation or reversal You'll see continuations or reversals during New York session and strong volatility. And when the sessions overlap, right, such as a New York and London session, they overlap, it's those are the best trading opportunities. When you see the sessions overlapping, like the New York and London, those when you catch the best trading opportunities, just like it happened right here. So we saw, news happen at 5:30 during this time at New York session. 5:30 was unemployment claims. And then New York Open happened at 6:30. And then it resulted this bearish move to the downside because you got this confirmation candle and you saw the resistance level. And then you have the supply zone here. So there's a strong selling pressure here. So knowing this information and looking at the confirmation candlestick pattern, you're confident to enter the trade because you're following each step. You saw the market direction, the 4-hour market direction going down. So the overall trend was going down here. Let's pretend that this hasn't happened yet. We're right here. So we see the overall market trend is to the downside because why? We have, the higher high here, and then went from higher high to lower high to lower low, lower high, lower low, and create another lower low here, a lower high, I'm sorry, lower high here. You see? So the overall trend is to the downside. So that's a check on step one. And then you saw the 1 hour supply and demand zone. In this case, it's supply. It works the same when you look at looking at buys. And here in this case, it sells. So you look at your supply zone here, the supply zone, and then you have your resistance level here at 33.45. Remember, every $5 on gold is a key level, every $5. So you saw your support level there, 33.45. Boom. It is a support level because it was a support at one point here. It was bouncing around this price level, came back down, break of structure, came back to retest, boom. It came back to retest again. So it's a strong support level, right? The support became a resistance. So when you see on a downtrend, support becomes a resistance. Oops. Now you figured out at the 1 hour, you marked up your supply and demand zones. In this case, the supply zone, you marked it up. You marked up your support level. And now you go to step three, the break of structure and retest. Step three, break of structure and retest. It broke below structure, came back to retest this level. Boom, there you go. And then you gather your liquidity. Where's liquidity here? So you have liquidity here to the downside. You have liquidity here. You have liquidity here. So price eventually is going to move up to wipe these sell orders here, to wipe out these sellers. There's the sellers here. This is all liquidity. So price came back up to liquidate these sellers. And then you look at your confirmation candle. You found the confirmation candle here, looking at the 15-minute. Saw the confirmation candle here. You also see you saw the bearish engulfing candlestick pattern here. This is the bearish engulfing, indicating that price is going to continue down. and then all of a sudden it went up. You know that the overall trend is going down, so you want to trade with a trend. You don't want to go against a trend. So when you see these pullbacks, right, these pullbacks happening, there's just a pullback, it's temporary, but you know that the overall trend is going down. So you don't want to enter this buy here, right? This is all just liquidity. You don't want to enter this buy because you know you're going against a trend. So you want to wait and be patient and wait for for more confluence to cash to sell. And you know that you have liquidity up here. So price is pushing up because there's liquidity here to wipe out this liquidity. And now you gather your confirmation candle. Your confirmation candle is right here at 6:30, right at New York open. This candlestick confirmation pattern, this doji, this gravestone doji happened right at 6:30, liquidating these sellers and pushing price down. So right at 6:30, right at New York open, you could have caught that trade with a sell to the downside. Now here, this is the video where you can, it's the importance of time. This is a video for the importance of time, why timing matters, why time is so important. You don't want to just enter randomly. You want to wait. And every 15 minutes, price tends to react. So put that down on your notes on the side note. As a side note, put down every 15 minutes, price tends to react. So look out for every 15 minutes. I like to look at the 15-minute time frame or the 5 minute for potential executions. So every 15 minute, there's a potential, reversal or a continuation or a break of structure. So every 15-minute, price tends to react. So here in this case, price right at 6:30, price gave me this confirmation candle for the continuation to the downside. Now this is a video for just looking at time, the importance of time and the key overlaps of time. You see, London plus the New York overlap is most active, and you catch the biggest moves. Sydney plus Tokyo overlap. It's good for, JPY pairs like JPY and AUD. It's good for JPY, AUD, NZD pairs. So I like to trade, me personally, during New York sessions, uh, London and New York overlap, because you catch the most active and the most biggest moves, just like how we saw here. Now, I appreciate you guys for tuning in. And remember, time in the markets equals understanding when to act and when to wait. It helps you catch high probability moves, you manage risk better, and grow consistently. And and I want to leave you with this. The compounding growth, okay? Long-term investors benefit from these moves. Long-term investors benefit from uh, they benefit more from time in the market than trying to time the market, if that makes sense. So compounding growth of your account. Long-term investors benefit more from time in the market than trying to time the market. Time in the market, meaning that you understand, just like I mentioned before, you understand when to act and when to wait, and it helps you catch better moves. This is where patience and discipline comes in as well. Patience and discipline. Time in the market teaches traders to wait for confirmations instead of forcing trades. Time in the market teaches traders to wait for confirmations instead of forcing trades. Patterns and cycles. Price often moves at certain times of the day, week, or around news events. That's when you catch cycles in the market. Price often moves at certain times of day, week, or around news events. And when you're doing your timing of entries, entering too early or too late can turn a good idea into a losing trade, just like I mentioned before. If you're to enter early on this trade, on this sell, you could have missed the move. right? If you were to enter here on a sell, you could have, if you were to enter here, right? Let me go out to 50-minute actually. If you were to enter here for a sell, you would have missed a trade. If you were to enter here, your stop loss would have been hit, right? If you were to enter here at 6:15 or 6:10, 6:09, 6:11, or some random time, right? If you were to enter here, if you were to enter early, you would have been stopped out. Or if you were to enter late here, if you were to enter after 6:30, let's say it's 6:30, I don't know, 6:37 or 6:40 or 41 or 42, like whatever random time, if you were to enter too late, you would have missed, the good entry, right? And then if you were to enter late, you could have been stopped out as well because price came back up to the zone, right? And if you were to enter down here, enter too late after New York open, price eventually went up and then you could have been stopped out. And then it went up to retest again this area for the continuation to the downside. So that is why you want to practice your trade entries. You want to consistently to practice your trade entries. So entering too early or too late can turn a good idea into a losing trade. And you also want to make sure of the different sessions, the London, New York, and Asian, and Sydney these different sessions, they bring different levels of volatility and liquidity in the markets. So and look at Forex Factory. Look at Forex Factory. Look at the different times. Look at the different news events. And so that way you guys can and practice using this, practice looking at news and practice at how it correlates with the markets and technicals. So as a fundamental trader, I highly recommend you guys focus on news because you guys don't want to be liquidated from these hedge funds and institutions. You want to trade like the banks. You want to treat this like a profession because this is a profession. Don't treat it like any side hustle or any hobby because this is a profession. This is serious. This is your money, right? That you're trading, that you're risking. So take it seriously, guys. Don't play with it. Don't treat it like gambling. It's not gambling. So have that mindset. Shift your mindset. And I highly recommend you guys check out the book Trading in the Zone. Trading in the Zone by Mark Douglas. Because that book will teach you the discipline, the mindset that it takes to become a successful trader in the markets. And ever since I read that book, it changed my whole perspective about the markets. And I saw it, I began to look at the markets differently. All right. So, um, but yeah, and all those resources, all those books are in my Telegram channel. So go back to my the home page on my channel, click on under the description, click on the link to the Telegram channel. It'll take you to my Telegram channel, and you have access to the ebooks, to the Trading Candlestick Bible, to Trading in a Zone, Naked Forex, Infinite Banking. You'll have access to all the financial literacy books for you guys to get educated and learn and continue to improve your skill set. Now, I appreciate you guys for tuning in. Look out for the next video. The very last video I'm going to cover is on executions. So stay tuned, and I'll see you guys on the next one. God bless.